Hello everyone. I hope everyone's doing fine and staying safe. Before starting this session, I want you all to have a pen and paper in hand. In case you feel something important, please note it down for your future reference. Okay, so let's move to our today's topic, that is taxes. Our income's huge part goes into an expense called taxes, right? And we don't have a choice but to pay taxes regardless of whatsoever happens to us. So, knowing about taxes is as important as knowing about all other ways you can generate income. And I'm sure you all fully aware that billionaires like Warren Buffett, Rakesh Jhunjhunwala pays less tax as a percentage of their income than us as normal middle class people. Now the question is, how do they manage this? Do they know something that we are missing out? Or maybe do they plan their expenses? Let's figure out in today's session. So basically, taxes are huge. But today, what we are going to talk about is taxes on listed equity shares for an individual like us. All right, then let's dive into some basics first. How does our income is calculated in income tax? Broadly, it's divided into five heads of income. First being salary, where all the income related to salaried people comes in. The second being house property, where all incomes related to rent or your property comes in. The third being profit or gains from business or profession, which is also known as PGBP. In short, where all your incomes related to business or if you are doing any profession comes in. The fourth being capital gain, where income related to your shares, your mutual funds comes in. The last being other sources, where all other incomes, if couldn't be classified in all other four heads specified, you have to classify those incomes in other sources, like interest on debts or maybe dividends, which we receive on shares. Now, combining all the incomes from these five heads, we get total income. But don't worry, all this is not important for income related to shares. The two heads which we will be focusing on is PGBP and capital gains. Now first let's discuss when will we classify share market income as PGBP or capital gains. It depends on factors such as have you taken loan to invest in shares or is it through your savings? Now if you have taken loan, it might be considered as business income because as they say you never take loan for investment purpose. But if you have done it from savings, then it might be counted as capital gains. Now, the second factor could be what is your intention to hold? Are you buying for trading purpose? Then it will be counted as business income. If you're holding it for more than a year, then it will be counted as capital gains. The third factor would be you as an individual say that I wanted to include in business income. Then it's perfectly fine. Government has no restrictions on it. If you say you have to hold it for more than 1 year, government won't object and it will be counted as capital gains. It should be a delivery shares, of course. Now, there are other factors also, but we are just focusing on the basics one. Okay, so these were the basic factors wherein we classify income as PGBP or capital gains. All right, now we're going to talk about some small points. First, as we all know that we pay taxes on profit, right? So what if we have loss? The question is, what if we have loss and no profits? Then what? We can use these losses to set off from our profits. That sounds great, right? Set off our losses. How? Set off means we are using profits to cover the losses, which will reduce our profits, indirectly reduce our paying of taxes. Let's understand with a few examples. Let's say if you have loss in house property, you can set off the loss from salaries income. Maybe you have a loss in business or profession. You can set off that loss from house property. Of course, there are some restrictions and limitations, but the point is Why am I explaining you this? The whole reason is there are two things which you need to remember always. So intraday is when you're trading on a single day. It is always stated as business income. The only difference is that you can set off these losses of intraday trades from profits related to only and only intraday. So that is there. You have to always set off your losses from intraday profits only. And say, suppose you don't have any profits on the first year where you're having a loss. Government says, no problems. You can carry it forward for the next year. Maybe you will have profit there. There's no profits on the next year too. Government says, all right, you can carry it forward till the fourth year. Then you don't have a choice, but you have to remove your losses as if it never happened. Now, talking about the second, futures and options, derivatives, or maybe trading. These all are classified as business income, and their losses can be set off from any head of income except salary. So maybe if you're having a loss from all these trading and all, you can set off your losses from from their profits and also from other heads of income, which we discussed earlier. But you can set off these losses up to 8 years. So these were the few details, but I guess this much will be enough for you. Like there are more about losses, but till now, you get it what I'm saying? All right. So moving on to the next. Okay, so let's sum up what we have talked about. First, we have talked about heads of income. Then the second, we talked classification of income from shares. The third we discussed was losses. And now we're going to discuss the purchase cost of a share, which is very important. Have you ever wondered why you are charged a little extra when you buy those shares? They are the extra charges which you have to pay instead of a purchase share. First being you have to pay the purchase price, which is number of shares into the price which is you are buying. The other charges are brokerage fees, which depends on your broker to broker. The third being security transaction tax, which is at the rate 0.1%, a very minimum one. The fourth being exchange transaction fees, which is at the rate 0.00345%. The fifth being GST at the rate 18%. The sixth being SEBI fees. SEBI is Security Exchange Board of India. They charge a fees. SEBI is a regulator. So they charge a fees, which is at the rate 0.0001%. The last is stamp duty, which is at the rate 0.015%. So these are the charges which we have to pay when we purchase a share and also when we sell a share. The rates might differ if you don't take delivery of shares. It depends on the situation then. If what I tried to explain from the start is crystal clear to you, then you are now ready to enter the hardcore of today's agenda. That is, let's talk taxes. Firstly, as I said at the beginning, that your income either goes in PGBP or capital gain. According to that, even taxes differ depending on that. If your income from shares is considered as daily course of business, that is trading, derivatives, options, futures, or intraday, normal tax rates are applicable. That is the normal rates that are applicable for all your income you earned in all your heads, except capital gain. We'll discuss that later. So the first 2,50,000 of your income, you have to pay zero rate. Like there is no tax for it. So there is written nil rate. The next 2,50,000 of your income, you have to pay 5% tax. The next 5 lakh of your income, the tax rate is 20%. And the rest income, after paying 10 lakhs, which is already covered, you have to pay tax on 30% of your income. Now let's understand this with an example. Suppose your income from trading in shares in a year, let's say suppose it comes to 13 lakhs. All right. Now the first 2,50,000 of your income, you don't have to pay any tax, which we discussed. This limit 2,50,000 might change for senior and super senior citizens. Now the next 2,50,000 of your income, the tax rate was 5%, which comes to 12,500. Now the next 5 lakh of your income is to be taxed at the rate 20%, right? So which is come to 1 lakh. Now our total income was 13 lakhs and we have already paid tax on 2,50,000, again 2,50,000 and 5 lakhs, which comes up to 10 lakhs. So the rest income which is left is 3 lakhs. The tax rate was 30%. The tax rate was 30%. So 3 lakh into 30% comes up to 90,000. So add all your tax you need to pay 0 plus 12,500 plus 1 lakh plus 90,000, which comes up to 2,02,500, which is to be paid to the government. So this is how you calculate your tax on normal income. Now, why am I saying normal income? Is there any abnormal income? No, there is a special income with special tax rates which are applicable to income related to capital assets. The rates which I explained you before is not what you pay on capital gain. There are special rates for them. To make you understand that, let's divide our capital gain into two halves. Either it will be long-term capital gain or short-term capital gain. Now, when profits are received, when capital assets has been held for more than 1 year before being sold, it is termed as long-term capital gain. Same when the profits are received when capital assets has been held for less than a year before being sold, it is termed as short-term capital gain. Now even tax rates differ. If your income is from long-term capital gains, then do you remember I said on normal tax rate that you have to pay 0 tax on 2,50,000 of your income? First 2,50,000, right? Here in LTCG, we call this long-term capital gain as short in LTCG. The limit is 1 lakh for every individual. So basically, you don't have to pay tax on 1 lakh of your long-term capital gain. Rest all gains from your long-term assets is taxed at rate 10%. Okay, so let's discuss taxes on short-term capital gain. In short-term capital gain, there is no such limit. If you have to pay taxes on whole income at a rate of 15%. So you can figure it out. Yes, short-term tax rates, it's more than long-term tax rate, as government clearly wants to encourage people to invest their money for long-term purpose. So this was special rates. Also, if you have loss from capital gain, it can always be set off up to 8 years with certain limitations. This is important that you check when and how can you set off your losses. All right. Let's take an example. Let's say suppose you have 20 lakhs as your gross capital gain, where 10 lakhs was from long-term capital gain and other 10 lakhs was from short-term capital gain. So how will we calculate? First, let's discuss short-term capital gain. The first 10 lakh of your income, there's no first, there's only 10 lakhs, which is at the rate 15%, which comes up to 1,50,000. Now for long-term capital gains, just remove the 1 lakh from your total income, which is 10 lakhs minus 1 lakhs, as I said earlier. No tax on 1 lakh of your long-term capital income. Rest 9 lakh will be taxed at the rate 10%, which comes up to 90,000. So total the tax to be paid is 1.5 lakhs plus 90,000, which comes up to 2,40,000. Okay, all right. Is it clear, everyone? That brings me to the end of my presentation. Did I succeed in explaining taxes for equity shares to all of you? If you have any doubts or any questions, feel free to ask in the comment box. Anything you want me to explain you again or parts you couldn't understand, just feel free. And again, thank you guys.